Hello everyone, thanks for checking out my video. We have entered a new earnings season as major US banks led the way last week, but investors didn't seem to be too happy with their results. Couple it with rising geopolitical tensions and persistent inflation, the stock market saw a sharp sell-off last Friday. As a result, S&P 500 suffered its worst day since January and its worst week since October 2023. So, is this the pullback that we all have been waiting for? With the earnings season underway, will corporate earnings complicate things? In my view, this is going to be a make or break season. And all of a sudden, it seems like so many things are going on. Let's dissect them in this video. As usual, do stay throughout to find out more. Last week was a really eventful week. The dramatic week started with the release of CPI inflation data on Wednesday, 10th of April. The key inflation gauge rose 3.5% year-over-year in March, which is higher than the expectation of 3.4%. The core CPI also came in hotter than expected at 3.8%, as compared to the forecast of 3.7%. Additionally, the month-over-month numbers were also higher than what analysts have predicted. With this latest set of data, it means the market has seen a hotter than expected inflation report for 3 months in a row. Previously, the Federal Reserve has mentioned that a single data point is not conclusive, and some analysts also prefer to see reports based on 3 months average. So there you have it, 3 straight months of hot inflation numbers. This simply shows that the Fed's inflation battle is far from over. Anyway, almost immediately after the CPI numbers were released, the market reacted with stocks tumbling, US dollars jumping, and bond yields rising. Currently, the market is pricing in just 2 interest rate cuts for the entire 2024 instead of the previous 3 rate cuts. And mind you, around the start of this year, the market was expecting up to 6 rate cuts beginning from March. How things have changed, huh? So, the very next day after the CPI numbers were released, PPI, aka the Producer Price Index, came in softer than expectation at 2.1% year-over-year versus the estimate of 2.2%. The month-over-month increase of 0.2% is also lower than the expectations of 0.3%. And this suddenly provided some form of relief for the stock market, and it rallied quite hard on that day, with Nasdaq hitting a record close. However, if you actually dive in deeper, you will realize that on a 12-month basis, the PPI climbed 2.1%, which is the biggest gain since April 2023, about a year ago. This again shows that inflation remains elevated, if not very sticky. And then came Friday, where the major US banks, namely JP Morgan Chase, Wells Fargo and Citigroup, kick-started a new earnings season. Well, to be honest, their earnings weren't too bad. In fact, some of them have beaten the top and bottom estimates. But somehow the market didn't seem to like their reports and outlook, as all 3 of them said that their net interest income has dropped. In case you don't know, net interest income is an important measure for many banks, as it measures the difference between what the banks earn on their assets and pay out on their deposits. In addition, JP Morgan CEO Jamie Dimon warned investors that trouble could lie ahead, as there are a number of significant uncertain forces. Again, in case you're not aware, this guy is actually one of the more quote-worthy person in the US financial industry and in Wall Street. What didn't help on Friday was the news that Israel is bracing a possible attack from Iran, which further escalated the tensions in the Middle East. And wow, that was a long recap, but I hope that has helped to summarize the key events that happened last week. Moving over to market outlook, there will be more earnings from financial institutions this week, with Bank of America, Goldman Sachs and Morgan Stanley lining up. Given the previous big 3 banks not offering any comforting economic outlook, I think we shouldn't expect too much from these 3 giants as well. Other big names that the market could be watching are Netflix, Johnson & Johnson, United Health Group and ASML. One particularly interesting event that is taking place this week is that our dearest Federal Reserve Chair Jerome Powell will be speaking at an event on Tuesday, 16 April. I would think the market is very interested in his view on the latest CPI report and also any revision to their forecasted rate cuts trajectory. Last but not least, throughout the week, there are also a number of other Fed officials and minions speaking, which could again sway the market expectation on both the timeline and the number of rate cuts in 2024. Let's now cover the technical analysis portion. Well, the market had a little sell-off last week, and SPY has retreated to an interesting level, which is the 50 moving average. A look at the chart shows that this level has not been tested since SPY went above it in November 2023. This simply means that this is the first test for the bulls. Come this week, if this 50 moving average, which currently sits at 508, gets breached, I would say the probability of SPY going towards the gap between 495 and 501 is quite high. Because by breaching the 50 moving average, it also means SPY is breaking below the 23.6 Fibonacci support level and is also going below this consolidation area that it has been in since early March. That's kinda bearish in my opinion. Meanwhile, I have shared in one of my previous videos that in a solid trend, whether is it an uptrend or downtrend, the counter trend movement will usually end at either the 23.6 or 38.2 Fibonacci levels. But for this case, if SPY moves lower, aka the counter trend, I will stretch it a little bit more to the bottom of the gap at 495. SPY has to bounce from here or any level above 495, because if it doesn't, then we are potentially looking for a reversal in trend. The next line of defense, in fact the last line of defense for this uptrend for SPY, is the critical 61.8 Fibonacci retracement level at 487, and coincidentally this is where the 100 moving average sits as well, thus forming a double support level. Bulls have to protect this level. Meanwhile, let me do the math for you. From the current level of 510 to 487, that's 4.5% drop. So anything below 487 is the kind of significant pullback that many have been waiting, and probably worth picking up some shares of good companies. And if we were to get here during this earnings season, I will update again on what's in store for the market. For instance, will there be a possibility of a correction, aka 10% drawdown from the top, or will there be a chance for a crash, aka 20% decline from the top? As for the upside, it's quite straightforward for SPY. SPY has to move out of this consolidation range between 510 and 524. If we have solid earnings from the various giant companies, and if SPY breaks above 524, 525 area, I do think the next target is 530's range, and it may go as high as 536 before a meaningful resistance level comes in. Moving over to Apple's chart. Remember last week I talked about how Apple was running out of space in this descending triangle and it was decision time? And yep, Apple made its decision and did it with a bang by putting a solid big fat green candle on the chart. That's a very bullish breakout. In fact, I actually tried to sell a cash secured put on that day of breakout, which is a bullish trade, but unfortunately it didn't get filled. During intraday, Apple flew up like crazy, and the momentum continued into Friday even when almost the entire market was down. Anyway, I told myself not to chase it since I have missed the opportunity, and I think that's something that viewers can consider. Never chase a trade if the setup is gone. Okay, come Monday, if Apple puts another green candle with the intraday low not lower than last Friday's low, then the bullish momentum will likely continue and we could potentially hit 180's range again, so watch Monday's movement carefully. At 180, I would expect Apple to face a bit of resistance because that was the level which acted as a support previously, and it now has turned into a resistance level. For Apple to really stick its bullish claim, it needs to reclaim that 200 moving average at 182, which coincides with the critical 61.8 Fibonacci level. This level, in my opinion, actually presents a stronger resistance than the earlier 180 level. And if you were to ask me, I think it is going to be an uphill task and challenge for Apple to go above 182 this week. Alright, on the downside, Apple could potentially get rejected by the resistance levels that I just mentioned, namely 180 and 182. But before that, as shared in the SPY technical analysis segment, in the strong trend movement, the counter trend typically gets rejected at either the 23.6 or 38.2 Fibonacci levels. And we actually saw that on Friday as Apple tried to go above 38.2 Fibonacci level towards the 50% Fibonacci level, but got rejected during intraday, and it is currently sitting right at the 38.2 Fibonacci level. This is the reason why I said this coming Monday or maybe even Tuesday's movement would be important. I would be watching whether Apple falls below the current 38.2 Fibonacci level at around 176 or not. If it does, it means last week's breakout could be a false breakout and Apple could retest the strong support level of 165 to 166 level. Speaking of this area, it appears to me that some big whales are protecting this zone. It could be Apple buying back their shares or could be some institutions at play, I don't know. But whichever the case, to me, it simply means that this 165 to 167 zone is very important. If it gets breached, we can say hello to 150's range again. Let's now hop over to Tesla's chart. Alright, since Elon Musk announced that robotaxi will be unveiled in August, Tesla has temporarily stopped its rot with a small little bounce. But as shared previously, Tesla is not out of the woods unless it can go above 177. And look at where is 177. It's the 38.2 Fibonacci level. Well, Tesla did attempt to go above this level last Tuesday but got rejected. This once again shows that if a stock wants to reverse its heavy trend, in this case a downtrend, it has to reclaim at least the 38.2 Fibonacci level. Therefore, in terms of the bullish thesis, this is one very important level for you to watch this week. No 177, no bullish talk. Okay, if somehow Tesla can go above 177 this week, despite all the bearish sentiment surrounding the company, then I would say it's going to be a momentum play, as the momentum will likely bring the stock up to the 50 moving average at around 181, and perhaps even the gap area between 184 and 186. For a full-blown bullish run-up, Tesla needs to take out the critical 61.8 Fibonacci level at 188. When that happens, I think the chance of it riding the wave all the way up to 200 is quite high. Alright, this segment is very important. I would like to make a small announcement. My YouTube channel has finally been fully monetized. I started this channel back in December 2021 and it's April 2024 now. Wow, that's close to 2.5 years. I know this is considered super slow as compared to many other YouTube channels out there. But that being said, I am very thankful to achieve this small little milestone and I don't want to discredit the subscribers of this channel. So really a big thank you to those who have stuck around since the early days of this channel. And of course, thank you to all the recent viewers and subscribers too. By the way, if you have subscribed to my channel when I had less than 200 subscribers, could you let me know in the comments section below? I really want to know. Meanwhile, just to share, given the views that I get from my videos, even with the monetization, it's not gonna make me rich. It's probably a few cents or a few bucks per day of ad revenue at most. But if you have been following me, you would know that my intention isn't really to make a fortune out of YouTube. I am doing all this free weekly content because I am passionate in sharing what I know, despite having very limited knowledge. Anyway, sorry for taking up a bit of time for this video, but actually if you are not a viewer who watches from the start to the end, you would have probably skipped or not say this part. As for those who watch almost every minute or second of my videos, once again, I am really thankful for your support. Alright, the next milestone is to cash out my first paycheck from YouTube, which requires 150 Singapore dollars, around 113 US dollars. I will keep you guys updated when the day comes. Meanwhile, don't forget to keep the like buttons coming in, okay? Alright, back to business. In terms of the downside for Tesla, which I think most people think is more likely to happen, Watch for the level 160. Again, I got to be honest with you, the moment Tesla broke below that bear flag, I really thought we could see 150's range very soon. But somehow the buy orders kept coming in at the 160's range and bears can't seem to bring the stock below 160. Right now, the biggest question is, with the poor delivery numbers and potentially poor earnings and forecasts for the rest of 2024, how much bearish thesis has been built into the current share price? And how long can the boost defend this 160's range if more and more bad news come out from the earnings? Honestly, if we get a big stinker from the earnings and if Elon Musk doesn't sound convincing in his conference, then maybe that's the time for 150's range. So if we ever get to 150's range, then I would say the gap between 146 and 152 will act like a magnet to pull the stock price to that area. This area is also where the bottom of this downtrend channel is. Okay, something interesting to share with fellow viewers. According to the website Options AI, over the past 4 earning days, Tesla share price moved 9 to 12% after they reported their earnings, and the expected movement for the upcoming earnings is around 9%. Well, 9% downside from the current level of 171 will see Tesla dropping to 155, right in the middle of the 150's range. As for the upside, it's 186. But let's revisit this again in my next video right before the earnings week. Meanwhile, I must say this percentage of movement is not guaranteed, okay? But it's definitely something worth keeping at the back of your mind, especially if you are trading options before its earnings. Last but not least, let's check out Google. Finally, Google has played out according to my technical analysis. In my previous video, I shared that if Google goes above the trend line again, we could then see another all-time high, and the route towards 160 is still intact. Ladies and gentlemen, Google did exactly what I said as it hit all-time high last week and kissed the level 160 before getting rejected. And I hope that warrants a like button from you. Okay, what's next from here? Well, I don't quite like that candlestick on Friday. That's called a bearish gravestone doji candle. To explain in very layman terms, it means the bullish rise in the share price at the start of the session was overcome by the bears at the end of the session, and this suggests a potential reversal in the uptrend. But I always say don't look at one indicator or candlestick only. So I look elsewhere, and unfortunately I have spotted one other bearish sign and one potential bearish sign. The first bearish signal is a bearish RSI divergence, while the potential bearish signal is the MACD looking to have a bearish cross anytime, but the latter is not confirmed yet. Also, for further confirmation of this reversal in trend, the next candlestick is critical. If the next candlestick, which is on Monday, closes below the closing price of the doji candle, in other words below 157, then yes, the bearish thesis could play out. When that happens, watch the green dotted uptrend channel line. If Google falls below that line again, then things are getting bearish for Google. We can then expect Google to revisit 153 or 148. The worst case scenario for Google would be to fill the gap between 143 and 146. At this area, it may fall a little bit more to the critical 61.8 Fibonacci level, and then that's when I would expect buyers to step in. Unless of course Google's earnings disappoint big time next week. On the other hand, if Monday's candlestick closes below last Friday's close, then the bullish momentum could continue. I mean, I have shared this a few times. When the stock keeps hitting all-time high in a short time span, typically the market will let it ride up a little bit more before people starting to take profits, and then the share price starts to fall. Anyway, above 160, the next two resistance levels are 162 and 165. But honestly, if we see another all-time high this week, and if I am a bear, I would not take any bearish position until I am clear that investors are starting to take profits or trimming their positions. Let's now switch over to the options trading segment. Last Tuesday, 9 April, I saw a new cash secured put on Tesla with a strike price of 140 expiring on 24th May. this is a risky trade. I repeat, this is a very risky trade. Actually, it seems like I have said this a lot of time to many other trades as well. Anyway, let's first cover why did I make this trade. So, I basically saw two bullish signs on Tesla's chart. First, Tesla has this nice little bullish double bottom pattern as it bounced off 160 level twice. And what amazed me was that both levels were exactly the same at 160.5. It's so precise. Secondly, on the RSI, a bullish divergence was formed, and this was followed by a confirmation of two solid green candles as Tesla reclaimed the first resistance level at 171. As a result of these bullish signals, I decided to sell a cash secure put, which is a slightly bullish trade. But why did I still say that this is a risky trade? Well, the reason is because the bullish momentum has not been confirmed yet. As I have shared in the technical analysis segment, I wouldn't consider Tesla being out of the woods unless it can go above 177. Right now, Tesla is still floating around the resistance turn support level at 171, showing that it is lacking strength to go further up. Another huge risk and headwind for my trade is Tesla's earnings results, which is scheduled for next week, 23rd April. A big disappointment could potentially send Tesla all the way down to I don't even know which level. Furthermore, the sentiment around Tesla and its business is very poor right now. So with all this risk, I decided to give myself some buffer by selecting a strike price that is near the bottom of this blue dotted downtrend channel, and also below the gap between 146 to 152. A huge disappointment in their results and forecasts could see bloodbath in the share price, and I really think 150s and 140s could be in play. Alright, I guess then some of you may ask, if it's so risky, then why still open this trade? Well, the first reason is because options trading is a way for me to generate passive income, so I want to make sure I continue to have my monthly side income. Second, I always believe that every trade has its own risk, be it high or low. There's always a way to manage or reduce the risk. So for this case, I waited for at least two bullish signals, and I also chose a strike price that's below several key support levels in anticipation for a potential bounce or at least sideways consolidation. But most importantly, Tesla at 140 is a price that I don't mind getting aside if all else fails. In short, know what you are trading and always have a plan for the worst case scenario. So yep, I hope you have learned something. Next up, I had this cash secure put on Apple that expired last Friday, 12 April. The strike price was 165 and the contract was sold on 5th March 2024. The reason for selling this contract was very simple and not new to long-term followers of this channel, and that is none other than overreaction. So back then, the market overreacted to the news of poor iPhone sales in China. As a result, Apple had a sell-off with two gap down, and the RSI reached a super oversold level. For the gap down, the last time it happened, Apple jumped 30% shortly after. As for the RSI oversold level, Apple only reached that level 3 times in the last 6 years. Again, shortly each time it happened, Apple rebounded. For more detailed explanation of this trade, please refer to the video linked at the top, and stay subscribed so that you don't miss out on any updates. Anyway, since I sold that contract, Apple rebounded a little bit and followed by some sideways movement. My strike price of 165 was never breached as Apple only went as low as 167. As a result, the contract expired worthless and I got to keep the full premium of $253 without having to close my contract. Finally, I had another cash secure put that expired last Friday, 12 April. This one is on Google. The strike price was 130 and the contract was sold on 1st March 2024. Once again, the rationale behind this trade is overreaction again. So what happened was that on 26 February, Google's generative AI tool Gemini made some blunder. Because of that, the stock fell 4.4%, losing more than $17 billion in value in just one day. To me, that's overreaction by the market. And so I let the stock settle a little bit for the next 2 days before pulling the trigger on 1st March. More details of this trade can be found in the same video as the earlier Apple's trade. Anyway, after I sold the contract, Google went very close to breach my strike price and it bottomed out at 130.66. But from there, the share price went on a monster run and even hit a few all-time highs along the way. And right now, Google is sitting comfortably above 150s. As such, my contract expired worthless and I got to keep the full premium of $155 without having to close my position. As the earnings season kicks off, investors are looking for positive corporate news, specifically their profits and company outlook, to balance what has been a rough patch of inflation worries and geopolitical tensions. My personal opinion is that this upcoming earnings season could be a make or break season, which will determine if we are going to have a decent pullback in the market. When I say decent pullback, I am referring to anything that ranges from 5% to say about 8% in S&P 500. Alright, so here's my take. The market has been rallying on the theory of AI boom and also on the basis that we will have about 3 rate cuts this year. But then, things have changed a little bit right now. Let's first talk about AI boom. The AI industry and stocks seem to be suffering from a little bit of exhaustion. As you can see from the charts, Nvidia has stalled out and lacks the strength to go above the 1000 mark. Microsoft has been trading sideways since mid-March, moving in a tight range between 415 and 430. Who else? Meta? Meta is also trading sideways and consolidating, or what we call range bound, since it had that gap up after its previous earnings. To add on, you also have Super Microcomputer, who rallied because of AI demand, moving sideways and consolidating. And for Google, despite hitting a new all-time high last week, actually went one round and back to roughly where it was in January this year. So as you can see, all these AI darlings and companies are experiencing a bit of buyer's exhaustion after they have all rallied massively based on AI boom. Next, in terms of rate cuts, the stock market has been trying to front-run the Federal Reserve and inflation data by pricing in an easier and lower interest rate environment, and that inflation likely to continue its downward trajectory for the second half of the year. But obviously, things have changed after last week's events as inflation remains stubborn and the market is now talking about a reduced number of rate cuts, and some are even saying no rate cut this year. I don't even want to mention about the noise of a potential rate hike again. Okay, so going back to the point why this could be a make or break earnings season, well, as mentioned, the market has been moving upward based on the two mentioned factors, AI boom and easing inflation plus rate cuts. Therefore, if these two don't materialize, then something has to happen to keep the market going up, and that would be none other than the company's earnings. They need to produce bigger and fatter profits to justify their stock prices, which many have mentioned that the current market looks too expensive by various measures. Furthermore, it used to be enough to mention AI 1000 times during an earnings call for Wall Street to celebrate and rally. But I think reality is going to set in this time. In the latest earnings season, these AI shouts have to translate to something to suggest that the hype-up returns in the stock market are justified. Not just that, companies have to also show that they can continue to churn out fat profits for the rest of the year if interest rate cuts happen less than expected or doesn't even happen at all. This is why I am of the view that there would be quite a lot of scrutiny on corporate profits and their forecasts in the new earnings season. We have already seen it last Friday where JP Morgan beat the top and bottom expectations, and yet the stock plunged close to 6.5% in one single day because the company gave disappointing guidance on their 2024's net interest income. Again, this is my personal view. I think this could be the earnings season where the market readjusts, re-evaluate or reprice the valuations of the various companies in view of the latest happenings. So buckle up and brace for impact. I personally would be keen to see if the dip buyers will start stepping in again to save the market. If they do, great for my long-term portfolio. Even if they don't, it's good as well because I will be deploying my dry powder to snap up some shares at discounted price. Speaking of which, I have stepped in for Microsoft last week. How about yourself? Have you been purchasing any stocks recently, or are you also waiting for a bigger pullback? Alright, that's all for this video. Do help me grow the channel by tapping on the like and subscribe buttons. Thanks a lot.